Welcome to the B.F. Anderson Technical Report for November the 15th. Well, let's get right into the charts here. We can continue to see here that the Nasdaq, which is the Nasdaq composite, the trend is down. There's no doubt about it. You need to have your defensive team on the field. Look, cash is not a bad asset to own right now, so you should have cash on the sidelines. It's just all portfolio management. I mean, if you're managing your portfolio for a buy and hold type of strategy, well, that's something else. But I'm of the opinion that if the trend of the market is down, you're fighting a very difficult situation. So let's look at the volume here real quick. Again, we started raising cash back here on the 23rd of September when we saw the extraordinary amount of volume come in on the downside on the Nasdaq. Now you can see, back here about a week ago, we were talking about a follow-through day. That follow-through day, what you need to understand about a follow-through day is that is a day where you have more volume than the prior day, and it's up volume. And the Nasdaq has to be up at least 1.25%. That day it was up 2.5%. Now, I'm not saying that the follow-through day has failed. What I'm saying is that the follow-through day doesn't mean the market is bottomed. However, there has never been a bottom over the last 100 years that there has not been a follow-through day involved. So what a bottom is basically a process. It's not a point in time. It's not like you come down here and go right back up again. It is a bottoming process. Now, the only really good news here is that we did have some decent volume on the upside above average earlier in the week. However, it has pretty much failed. The Nasdaq has broken below 7,200, which was somewhat of a key area, and we're seeing really pretty below average volume on any rally, and I will say that volume is improving. Now, if we look at it on a weekly basis, just a real quick snapshot here, this is the 35-week moving average. The basic rule is that we want to, if we go below the 35-week for 2 consecutive weeks, that is a sell signal. We are getting, last week we did get volume to the upside. However, it was below average. And so far this week, which we've got today and tomorrow, but it doesn't look like we're going to have abnormally high volume to the upside. So basically, the other point is that you're seeing here where the 35-week moving average is flattening out. The thing to realize here is that the leaders, meaning Apple and Amazon and Facebook and Google, and the ones that have been really driving the Nasdaq, those stocks are all pretty much in bear markets now. I mean, Apple went into a bear market yesterday when it broke below $188 a share. And the old famous investor, Jesse Livermore, back in the 20s, basically said that if you can't make money in the leaders, you're going to have trouble making money in anything. So just be aware of that. Now, here is a little bit of good news here. This is the HighLow Index, New York Stock Exchange HighLow Index. Again, it is where we take the number of new highs on a daily basis divided by the new highs plus the new lows, and then we get a ratio that we then plot on a 10-day moving average. You can see here that we have now popped back above 30, which is healthy. However, you have to realize that we got so oversold that this just could be what we call a dead cat bounce. But we are seeing more new highs and fewer new lows. And you can see that here on this graph here on the New York Stock Exchange number 52-week lows. However, yesterday we had 102 new lows. The day before we had 151. Again, we want to see that stabilize below 40 a day, and that's just not happening right now. A little bit of other long-term evaluation here. Now remember, this is the S&P 500. We're taking the 10-month moving average. We're comparing it to the 20-month moving average. This comes from Luis Yamada. We're looking for death crosses, which we're not getting one, but however, the index is below the upper moving average, which means that moving average is going to start to pull down if it doesn't break back up above it. Now, realize here, the death cross, we had bear market, death cross, we had bear market. We're not getting a death cross, but it's not positive. It's neutral at best. Now on the fear greed calculation, this is the CBOE options equity put call ratio. Now remember here, institutions hedge their portfolios using options. Institutions are 80 to 90% of the volume on the exchanges, so you really need to pay attention to what the institutions are doing. And we're seeing extreme fear. We got down into fear, then we bounced right back into extreme fear yesterday. Just be aware of the fact that this is a contrarian indicator. This is where when you see extreme fear, that's usually when the market puts a bottom in. And actually, that's what I'm looking for. Now, one subject I want to hit on real quick and kind of wrap it up with this. I want to talk a minute about dividends. One of the things we have found is that when the market gets sloppy and there's a lot of volatility, investors feel that there's a lot of safety in dividends. My first experience with dividends, I was about, I want to say I was about 14 years old. My granddad, who was a chief financial officer of a railroad, the Colorado and Southern Pacific Railroad, took me downtown Baton Rouge. We rode on the bus, in fact, to meet with his broker. And he had given me some money to invest. And so I said to Grandpa, I said, okay, what do you think we should do? And we ended up deciding on a company called Gulf States Utilities, which was the utility company for East Baton Rouge Parish, at least, or portions of Louisiana. And Grandpa said the main reason to own this stock was because it paid a dividend. Now, what you have to realize about dividends is that from an accounting perspective, it's cash out. It's not cash in. It's cash out. And realize now that when you buy a stock versus a bond, let's say, when you buy a stock, you're taking an ownership position. You're taking an equity position so that when cash comes into the company, let's say profits, that beefs up the balance sheet. It improves the balance sheet. So when you have cash coming in, it makes the company stronger, not weaker. But when cash is going out in the form of a dividend or interest payments or whatever, it makes the company weaker because there's less cash on the balance sheet. So I have here General Electric, which recently cut its dividend dramatically. You can see that this stock is just basically plummeted. And, we all know the story on General Electric. It's been all over the news. But if you really analyze why this company is in so much financial trouble, it's because they paid a too big of a dividend. And what happens is you get these management teams in there that they're pretty much told by the board that your job is to maintain the dividend and increase the dividend. And what happens is the management team gets into a trap where if they need to cut the dividend, they lose their job. So what happens is that these companies either don't cut the dividend when they should, or in some cases they raise the dividend. I was analyzing a company the other day that the interest payments on their debt payments, because they had like $6 billion in debt, and they were paying a dividend of about 100 million, or they were, in other words, I can't remember the numbers exactly, but they were paying more money out in interest payments than they were paying out in dividends. In other words, they if they would have been smart, or if they would be smart, they would shut down the dividend and get rid of that debt. But it's just a trap, and it's just something to be aware of. That you get involved in a GE, and people would say, gee, it's a safe investment. They pay a dividend. I don't think so. I don't think that's true. Now, there's another example of a company that recently cut its dividend is Anheuser-Busch, Budweiser. Now, what's happening to them is 75% of their revenues come from international markets. And because of the strong dollar, no one's buying their beer. And so the company's in trouble. So what they've had to do is cut the dividend. So just be aware of the fact that, what really makes more sense to me if you need income is, bonds and CDs. That's one route. Now realize with a bond, you're getting an interest payment. It's not with a stock, what you're really getting in the form of the dividend, it's like you're giving yourself your own money back. In other words, you're taking equity out of the company and giving it to the shareholders. Well, it's money that the shareholders owned anyway. Whereas with a bond, it's just an interest payment. It's just a completely different situation. So, the best way to get income, I believe, is just to invest in the highest quality companies you can find that are beefing up that balance sheet and keeping themselves strong. And then as you need income, just sell off a few shares every quarter. That makes a heck of a lot more sense to me. If you have any questions, let me know. Happy Thanksgiving. I'll talk to you next week. But Thanksgiving is Thursday, isn't it? So we'll be doing our report on Wednesday. Thank you.